Yo, what's good, YouTube? It's Mr.BuyTheDip back here with another video. I'll be talking to you guys about long-term investments and kind of how to get into the stock when we're all the way down here. As you guys can see, 128 is something that we saw for NVIDIA. If you guys pinpoint this right here, okay, around this, if you got in right here, kudos to you, good job. This is exactly what you're supposed to do, right? But how can we pinpoint these, how can we pinpoint these prices? How can we know when to get in? Well, I'm going to talk to you all about it. There's a lot of speculations that goes into getting down there. If you can get all the way down to 128, then you see all green candles, right? And as you guys can see, the volume is kind of higher, okay? But then as the price gets higher and higher, volume gets lower. People want to hold more. They want to take profits and get out, right? So a lot of things like this can be seen when investing. So to me, a long-term stock is honestly holding a stock for longer periods of time while using good indicators. Okay, look at this, guys. I say good indicators to buy. Low prices are good indicators. Okay, I use the reversion strategy. Okay, that basically means to buy dips. So I like to get into a nice price so I can lower my average cost. Okay, that's my strategy of investing. I don't like to invest consistently every Monday, every Tuesday for 5 years, and I'm putting $10 every week, regardless of the price. That's not what I do. Okay, I like to use technical analysis. I like to be technical. I like to take my money and be like, okay, I have $300. I'm going to put this at the lowest point possible. And when I'm right, I like to take my profits and get out. Okay, so first things first, how to know when to buy: the intrinsic value, the PE ratio, moving day averages. Okay, under 200 day usually is a good sign for long term. If you guys don't know what a moving average is, it takes the closing price for 200 days, okay, and it gets an average of that. So if you want to be a long-term investor, you want to make sure you get in under the 200-day moving average, okay, or even just lowering your average cost per share. Okay, what does this mean? If my position in NVIDIA is all the way up here, okay, let's say I'm in for 135.60, okay, and the stock goes all the way down to, let's say, 133, or it goes all the way down to 128 right here. Okay, so if you see that opportunity and you see that your position in the stock, your average cost in the stock is 135, if the stock is under 132, 133, why not buy? Okay, I'm not saying buy $1,000 all at once, but 200 at 131, another 200 at 130, it goes down to 128, another 200 there, right? Buying at levels, so it's slowly bringing your average cost per share down. Slowly brings it down. The better position you get, so as the stock goes up, the more profit you can earn, and you can just hold and just play that game, play that holding game, or play that selling game of taking profit. All right, now intrinsic value is basically the true worth of a stock, okay, based on fundamentals like earning reports, cash flows, and the growth potential. Growth potential is always determined by a lot of analysts in Wall Street, a lot of analysts on, YouTube. You have people that have $1 million portfolios that talk about analyzing a stock and talk about certain prices. Okay, now, how important are earnings report? I'll tell you guys this. Earnings report are so important because a lot of buyers, they base their buying option based on earnings report. If the earnings report is bad, it's as simple as this. Okay, let's say I have a business and the business is doing bad. I've lost $5,000 the first 5 months of the year. What are a lot of people going to do? They're not going to just want to invest in your business. They're going to be like, I don't know, because you don't even have the customers to come into your store. Why the heck would I buy certain products from you, right? So earnings report, if you scroll all the way down on TradingView, by the way, I'm on TradingView. It's an app that I'm using. You can always see earnings report. Okay, you can make these you can set these in your calendar. As you can see, February 26, 2025 is the next earnings report of NVIDIA. Okay, now as you guys can see, I had more earnings, and I look at, I scroll down and I can look at certain things like dividends. How well do they pay dividends? Okay, NVIDIA is not the greatest for dividends, right? So I can go to statements, I can go to their overviews, I can see certain key factors about this company. I can see their market cap. How much are they in debt? Okay, debt really matters because they have to pay those back. Okay, when they get revenue is basically all the money they get in before their expenses. Okay, so they have to pay those back, and the higher debt the company's in, the more money they have to pay back. Okay, and they're gonna prioritize paying off their debt before paying back their dividends. Okay, that's probably one of the reasons why NVIDIA's dividends is not as great. They don't have the capacity to give dividends back to shareholders when they're deep in debt. Okay, now growth and profitability. If you guys can see the performance, it's NVIDIA has been on a roll. We all know they're up almost 200% this year. We knew the last December to 2024 in May, we had a crazy run. Correct. Now, the main thing I want to talk about is how you can look at technicals on TradingView. Okay, I'm gonna get into that in just a second. Okay, so I want to talk about how can you calculate the intrinsic value of a stock. You can use discounted cash flow. Okay, now using discounted cash flow is basically you have to add up. It basically adds up how much the company is projecting to make in the next few years. Okay, discounted cash flow is similar to free cash flow. Okay, now free cash flow is the amount of cash a company generates from its core business operations. Okay, subtracting its expenses. Remember, you guys, I said, let's say NVIDIA has $10 billion in debt. Okay, they have to pay that. Okay, so they're not going to take their profits till they pay off their capital expenditures. The capital expenditure is basically their expenses. Okay, it's a critical financial metric because it shows how much cash is available for the company to use. Okay, so let's say this amount is like 2 billion, 500 million. The more free cash flow a company has, that's how much ever money they can work with. So even if they're in debt like $500 million, okay, if their free cash flow is good, they can pay that off as soon as possible. Okay, so that's a good indicator as well. But what is free cash flow? The amount of cash a company generates from its core business operations, subtracting the expenses, is a critical metric because it shows you how much cash is available in the company. I just said this. Okay, so if a company has properties they have to invest in, capital they have to invest in, and stocks they invest in, right? So all of that, you subtract all of that, and that's their free cash flow. I hope you guys get this. Let's say I have a house, okay? I got bills to pay first, okay? I can't just go and live in my house for two years straight. I can't just buy whatever I want. I have to be able to pay my bills first. Then I can, live in my house and get whatever I want, spend money on clothes and all that type of stuff. Okay, now, free cash flow is the leftover cash from a company operations after it has spent money on necessary investments like, let's say, paying dividends, reducing debt. I just mentioned this. NVIDIA is in debt so much that they probably can't afford to pay so much back to their shareholders. Okay, we go to a company like Walmart, you scroll down and you see their dividend. Their dividend is, let's see their dividend, okay? You look at their dividend history, and you see how they consistently pay out good dividends. Dividend 1.56%. Okay, now compare that 1.56% to, let's compare it to NVIDIA. Now I know these are totally in different industry sectors, but I'm still going to compare them just to show you guys what specifically I'm trying to say. Okay, if I compare that to NVIDIA, you can go ahead and see that NVIDIA has a dividend yield of only 0.08%. It's not the best. Okay, so what does that mean? They're probably in debt more than they should be. Okay, which is fine. I mean, the company does well managing their risk, so they understand what they can offer and what they can't offer. That's the good thing about the company. Okay, now reinvesting in businesses and stock buybacks. Companies do stock buybacks. If you guys don't know what stock buybacks are, it's basically when a company repurchases its own shares, okay, which can help increase the price of the stock. Obviously, it's a signal confidence or return access to a lot of cash in shareholders. Okay, so these are a lot of stuff that I can just tell you guys about. Okay, I can just talk about these all day long. Okay, but some of the key indicators I'm going to talk about tomorrow, it's going to be MACD and it's going to be 200-day moving averages. I'm going to get into that tomorrow because I need probably more time, and I need to focus on those things. So today I talked about free cash flow. I talked about how NVIDIA's dividend yield is probably not as much, but they can go all the way up to 150, 149 per share, right? But what are some things that are holding their dividend yield back? If you want to be a good long-term investor, you want a stock that can pay decent dividend yield percentage out, right? But I realized that NVIDIA is not the one. Okay, it's not one of those ones where they pay out good dividends. So what do I take into consideration? I add a stock like Reality Income in my portfolio. Reality Income, now, on the other hand, pays out a dividend of I believe it's 5 point something, okay? If I'm not mistaken, I can load and wait for it. So I realized NVIDIA is not the best for dividends. I was like, okay, I'm going to substitute this in for Reality Income, and they pay a dividend yield of 5.4%, which is a crazy amount of dividend yield. As you guys can see up here, dividend yield TTM is 6.01. Okay, so if I go to their history, I can see their earnings, right? But I can also see some of the statistics they're talking about. But a 6.5 to close to 5 or 6% dividend yield is absolutely crazy. Okay, 4.68, and this can fluctuate as well. So on Cash App, I believe it was 5.3, 5.2 a few weeks back. As you guys can see, it kind of increases over the years. So it starts with 4.68 and it goes all the way to 5.33. NVIDIA started at 0.08 around 2020 and 2021. As they pull more money in, right, they go more in debt, and right now it's probably lower. It's probably like 0.02, 0.03, 0.04, whatever the case may be. So you have to definitely find a stock that can pay out good dividends. And good thing about Reality Income, guys, they pay out dividends every month. So I took that into consideration, but the main thing is understanding these key terms. Okay, what is capital expenditures? This is basically a type of investment the company does for itself. I have a good example to go along with this. It's, for example, let's say there's $1 million to buy new machinery. Let's say NVIDIA gets $1 million of new machinery. That $1 million is investment the company's making in itself. They need that new machinery. Okay, they can't work with old, out-regulated machinery, because what can do is that can allow threat actors. Threat actors is a whole topic in cybersecurity where you have people trying to hack the system. People, they do stupid, they run stupid amount of hacks, and they try to get into your firewall. They try to access crazy files and documents. So let's say they buy new machinery. Okay, that's an investment the company does in itself. Over the following years, the company will gradually recognize the depreciation expenses for that machinery. What that means is how that machinery helps them make money. Okay, and that investment turns into that $1 million that they spent in debt turns into profit, and it turns into a good way the company bounces back from not being able to pull away $1 million. Okay, $1 million is a crazy amount, but a lot of companies that make those type of investments, they need to be able to bounce back from those. So these are some of the not, I would say, so technical indicators, but these are some of the things to keep in mind whenever you look for long-term investments, guys. Let's go all the way to the top. Let's talk about it. Okay, we talked about intrinsic value. We talked about moving day averages. Okay, to how to calculate an intrinsic value, there's a lot of numbers you have to put in together, but you need to know the basic of it. Okay, it's trying to calculate discounted cash flows. Okay, now if you look, this is why you need a lot of numbers in order to just calculate an intrinsic value. Okay, I try to give you an example here. Okay, this is something a lot of people do. They look at year 1, year 2, year 3, year 4, year 5, but calculating this for a regular person who's just trying to invest can be a lot of stress. Okay, so instead of worrying about all this, what you guys can do is use indicators like MACD, use indicator like PE ratio, use the moving averages. 200-day moving average is a key point that I'm going to talk about tomorrow. But today I talked about what free cash flow is. Why can't a company usually pay out good dividends like NVIDIA? Okay, so the more expenses a company has, the more money they have to put towards that, because if they don't pay off their expenses, that turns into debt, and the more debt they have, the more the company's not going to grow. Okay, so paying dividends, reducing debts, reinvesting in the businesses, stock buybacks, these are all expenses. Just like you live in a house, you have expenses. Stocks have expenses. So let's assume NVIDIA is trying to lower their debt value. Okay, so what can we assume about the stock being all the way down to $128? Okay, you don't need to panic about that. Okay, this number one thing a lot of people don't understand, that the CEO, the owners, the employees, they are taking a lot of things into consideration when they look at these prices, and they look at the stock all the way down to 128. They need to be able to worry about the debt value first. As I showed you guys, NVIDIA's in debt a lot. The business is in debt a lot. So when we get all the way down here to 128, right? What can we do around 128, 127, 129? We can just buy. Okay, buy at levels, be patient, and hold this out. My goal is not to sell this till the end of 2025. Okay. Holding a stock for longer periods is as specific as a long-term investment can get. So 130, 135, 134 is probably a low day right now for NVIDIA, right? But think about it in 5 to 6 months. 5 to 6 months, 145 is probably going to be a low day for NVIDIA. Okay, so prices always fluctuate in the stock market, so don't panic, right? Look at technical and look at smart indications. Okay, the more you learn about how to make a good long-term investment, the more you're going to perfect your craft. Okay, so know about the intrinsic value, know about the PE ratio, know about 200-day moving averages, know about free cash flow, know about how the paying dividends, reducing debt, and reinvesting in the businesses can help certain stocks. So NVIDIA is probably really considering to reduce their debts right now, and while they're going through a lawsuit, while the greedy shareholders want some more profit, they want to put in their pockets. Okay, there's a lot of indicators that can be the reason why the stock is so low. Okay, so take these positives with you and just hold the stock out till June or July, and I guarantee tables are going to turn and everything is going to be upside down. Thank you guys for watching. Like and subscribe. If this video helped you kind of get a grasp, get a good understanding of part 1 of long-term investments, please let me know. I'm dropping another part tomorrow. I'm going to talk about more about how you can use this indicator right here. I'm going to hit the indicator bar, and I'm going to search 2 indicators that can really help you. It's going to be MACD and RSI, and I'm going to talk about those things. So